The calculator shock starts with about $163,000. That is the gap our simple model produced when the same $4,000 monthly capacity was tested at 9.25% instead of 6.25%. By the end, you will know why that gap appears, which other breaks sit behind it, and the 5 questions that make a lender's number useful. More importantly, you will know which parts of the result are policy, which parts belong to the lender, and which parts you can meaningfully change. The number is illustrative, not a promise about anyone's approval, but the rule behind it is real. APRA confirmed on the 28th of May 2026 that the minimum mortgage serviceability buffer remains 3 percentage points. We ran the repayment maths against that rule because the first calculator result can otherwise feel like a verdict written in invisible ink. Picture the ordinary version. You open an advertised loan near 6.25%, type in the income that pays every real bill, and expect the calculator to use the number on the page. Instead, the maximum comes back much lower than the house search you had already started. That can feel personal. Often, it is the stress test doing exactly what it was built to do. The screen shows one result, but it hides several assumptions that deserve to be unpacked. General information only, not personal advice. Check a licensed professional for your situation. The useful goal here is not to reverse engineer a bank's private model. It is to understand the map well enough that a lower number stops being mysterious and you can ask what actually moved it. Here is the cleaner way to see it. The product rate and the assessment rate are not rival offers. They have different jobs. The product rate helps set the repayment under your contract. The assessment rate is a higher test used during approval to ask whether the household could still cope if rates rose or income and expenses changed. For an APRA-regulated bank, the minimum buffer is 3 percentage points above the loan interest rate. So a 6.25% product rate commonly points to a 9.25% assessment rate. A 6.5% product rate points to 9.5%. It is addition, not a secret second mortgage waiting behind the curtains. Keeping those roles separate prevents the assessment number from sounding like a repayment forecast. That distinction matters emotionally as much as mathematically. You do not start by paying 9.25% merely because the bank tested you there. Your contract still controls the actual rate and repayment, but the higher test can reduce the loan size the bank is willing to approve. One rate prices the loan, the other guards the doorway. Why keep the doorway so tall? APRA describes the buffer as a contingency for future rate rises and unexpected changes in income or expenses. That can feel conservative when a buyer is already squeezed. Still, the number is not there to insult the household. It is there because a 30-year loan will meet more than one version of ordinary life. The current 3-point setting dates to October 2021, when APRA lifted the minimum from 2.5 points. APRA estimated that this half-point increase, considered on its own, would reduce maximum borrowing capacity for a typical borrower by around 5%. That history shows how a small-looking rate increment can move a much larger loan number. There is a quiet relief in this reframe. If the calculator result shifted because of an assessment rule, it does not mean the income disappeared or the household failed a character test. It means the model applied a thicker safety margin. Once the mechanism has a name, the next conversation can be about assumptions rather than shame. Chapter 3: The $4,000 Test. Assume a household has $4,000 a month available for principal and interest repayments in the lender's simplified assessment. Use a 30-year term. Ignore for one moment income, haircuts, expenses, other debts, and lender-specific floors. This is not a decision engine, it is a clean window into the rate effect. At 6.25%, that monthly amount supports an illustrative loan of $649,649. Raise only the rate to 9.25% and the supported loan falls to $486,218. The difference is $163,431. Nothing about the household changed between those two columns. Same repayment cap, same term, same hypothetical borrower. The assessment rate simply made every borrowed dollar more expensive inside the test. That is why borrowing power can move dramatically even when the advertised rate difference looks like a small line on a product page. The same model gives a second pair. At 6.5%, $4,000 a month supports about $632,843. At 9.5%, it supports about $475,707. Different starting rate, same three-point logic, and again a much smaller ceiling. There is also a paradox. If the bank approves the smaller $486,000 loan after testing it at 9.25%, the day one repayment is calculated at the product rate. At 6.25%, that is roughly $2,994 a month in this model. The test demanded $4,000, day one starts lower. That unused distance is the intended headroom. Headroom is not spare money guaranteed to survive. Real life can spend it through childcare, commuting, medical costs, reduced hours, straight-to surprises, or a rate move. But it explains why the first repayment can look easier than the approval test. The bank was never forecasting tomorrow's bill. It was asking whether the household had room if tomorrow became less polite. This is where a bigger deposit helps, but does not perform magic. A larger deposit reduces the loan required, so the stressed repayment also falls. Yet if the remaining loan still does not fit the lender's income and expense assessment, the deposit alone cannot repair the result. Deposit is one lever. Serviceability is the whole machine checking whether it can move. And this is a useful place to pause the house hunt for one evening. You do not need to solve the entire mortgage tonight. Write down the product rate you are considering, add 3 percentage points, and test the repayment at both rates. That will not reproduce a lender's answer, but it replaces a fantasy ceiling with a more honest starting range. Now for the other breaks. The buffer is only the most visible one. The second is debt to income, or DTI. From February 2026, APRA's high DTI guardrail allows banks to place up to 20% of new owner-occupied lending and separately investment lending at debt-to-income of 6 times or more. That is a portfolio limit on the bank, not a personal 6 times promise. That difference is easy to miss. The serviceability buffer changes the repayment stress test applied to a new borrower. The DTI limit controls the share of a bank's new lending that can sit in a high-leverage bucket. A household can be below 6 times income and still fail serviceability. Another can sit above it and still be considered within the bank's limited allocation. Neither threshold can be used alone to predict an individual approval. The third break is living expenses and existing commitments. A car loan, a credit card limit, buy now pay later facilities, childcare, commuting, and insurance can reduce the surplus before the mortgage test begins. 2 households on the same income can therefore receive different limits without either calculator being broken. The model is reading what remains after different lives. This part caught us out because a small credit limit feels nothing like a large mortgage. Inside serviceability, though, unused limits can still be treated as potential commitments, depending on the lender. The practical move is not to close everything blindly. It is to ask which liabilities were included, at what limit, and how much each one changed the result. Lenders also differ. They can use different expense benchmarks, income treatment, floor rates, and policy overlays while still operating within prudential expectations. Overtime bonuses, rent, self-employed income, and fixed-rate reversion assumptions may not be treated identically. That is why one calculator is a clue, not a universal price tag attached to the household. Fixed-rate products add a wrinkle. A low introductory rate may not be the rate that anchors serviceability if the loan later reverts to a higher ongoing rate. The lender may assess the relevant ongoing rate and add the buffer. The cheap sticker can therefore enter the model wearing a much less flattering jacket. Pre-approval is not the finish line either. It can expire, property valuations can change, and final assessment uses verified information. A borrowing power estimate is useful for orientation, but treating it as a settlement guarantee is how an exciting Saturday inspection becomes a very long Monday. Caution here protects options. It does not mean the plan is off the table. So the 3-break picture is this. The buffer tests repayment at a higher rate, DTI constrains the bank's high leverage share, living expenses and debts reduce the surplus available to service the mortgage. When a result disappoints, ask which break is binding. Otherwise, every solution looks like earn more. even when the real fix may be elsewhere. Here are 5 checks before the next inspection. First, ask for the product rate used in the quote. Second, ask for the assessment rate or buffer used. Third, ask which income was accepted and whether any of it was shaded. Fourth, ask which expenses, debts, and credit limits were included. Fifth, ask what single change would most improve the result. Get both rates in writing. What rate will I pay? And what rate did you assess me at? Are different questions and both deserve a number. If the assessment rate is not visible, the borrowing power result is incomplete. A clean answer lets you compare lenders on assumptions as well as advertising, then make the liability side honest. Canceling an unused facility may help in some assessments, but the useful sequence is check, quantify, then act. Ask the broker to rerun the model without a specific limit or after a particular debt is cleared. That turns a vague instruction to tidy finances into an observable before and after decision. Do the same with expenses without sanding real life down until the spreadsheet passes. Underdeclaring childcare, transport, or annual bills does not make the loan affordable. It makes the warning light quieter. A strong plan includes the household that actually exists on wet Tuesdays, not the heroic version that never needs a dentist or a new tire. Finally, separate maximum borrow from maximum comfortable. Approval answers what the lender may permit under its model. Comfort asks whether there is room for savings, maintenance, time off, and a life outside the mortgage. Those numbers can be different without either being wrong. The smaller comfortable number can still be the stronger move when it protects future choices. Your next step is small. Take the likely product rate, add 3 percentage points, run the repayment again, and write down the questions raised by the gap. Then ask a broker or lender which break actually set the ceiling. You are no longer staring at a mysterious rejection. You are reading a model, checking its assumptions, and choosing with clearer eyes. That is a much stronger place from which to plan the next inspection. If practical Australian money decisions feel easier when the hidden mechanism is made visible, subscribe. We will keep running the numbers, naming the trade-offs, and leaving you with one useful move rather than a pile of jargon. A lower ceiling is not the end of the plan. Sometimes it is the guardrail that helps the right version of the plan arrive intact.